What if I told you that you could start building a real investment portfolio with less than $10? Most people think investing is only for the wealthy. That is completely, 100% wrong. Today, I am going to walk you through 3 powerful steps to build your very first investment portfolio from scratch. No financial degree needed. No huge savings account required. Just the right strategy and the right mindset. Whether you earn $200 a month or $2,000, this framework works for you. Stick with me. By the end of this video, you will know exactly which 3 investment accounts to open starting today. My name is Alex, and welcome to Money Blueprint, where we make investing simple, clear, and accessible for everyone. Before we dive in, smash that like button and subscribe so you never miss a money tip that could change your life. Now let me give you a quick, honest disclaimer before we start, because your trust is everything to me. This is not financial advice. This is financial education. Always do your own research before making any investment decision. Step 1, and I cannot stress this enough, is building a real, working budget before you invest a single dollar. Here is the truth: budgeting and investing are not 2 separate things. They are the same thing in different stages. If you do not know where your money goes every month, you will never be able to consistently invest, period. A budget shows you exactly how much money is coming in, going out, and most importantly, left over to invest. Think of your budget as the engine of your investment vehicle. No engine, no movement. No budget, no portfolio. The simplest budget rule to start with is the 50-30-20 rule. 50% needs, 30% wants, and 20% savings and investments. Even if that 20% is only $5 a week right now, that is your starting line. Not a perfect budget, a working one. There are 3 types of expenses you absolutely need to identify: fixed expenses, variable expenses, and sinking fund expenses. Sinking funds are your secret weapon. They are savings accounts for big non-monthly expenses like school fees, insurance, or annual bills. When you cover these short-term needs inside your budget, you will never have to raid your investment accounts in an emergency. This is the #1 reason most people fail at investing. They keep pulling money out before it grows. Your investment must become a line item in your budget, as non-negotiable as your rent or electricity bill. Once you have a working budget that includes your investment contribution, even a small one, you are already ahead of 90% of people. To make this even easier, I have created a free budget template linked in the description below. Download it and use it today. Alright, budget locked in. Let us now move to step 2, and this one is going to completely change how you see money and risk. Step 2, understanding your risk appetite and the golden rule of investing. Risk and return always move together. Here is the golden rule: higher risk equals higher potential return. Lower risk equals lower but more stable return. There is absolutely no such thing as a zero-risk investment that gives you high returns. If someone promises you that, run. Before choosing any investment, ask yourself 3 critical questions. Question 1. Where exactly is my money going? Every investment product has an underlying asset. Know the asset and you automatically know the risk level. For example, a money market fund invests in treasury bills and short-term bank deposits. That is why it is considered low risk. Question 2. What is the risk level of those underlying assets? Low, medium, or high? You need to know this before investing. Question 3. What is the expected return and how long does it take to see that return? Short-term, medium-term, long-term. A huge mistake beginners make is investing long-term money and expecting returns in 2 months. That will drive you crazy. Now let's talk about your personal risk appetite. Ask yourself honestly, can I sleep at night if this investment drops 20%? If the idea of losing money for even a short period makes you panic, you are a low-risk investor, and that is perfectly fine. Your risk tolerance actually grows over time as your emergency fund grows, your financial knowledge grows, and your confidence grows. One personal rule I follow: I never invest money I cannot afford to lose or leave untouched for the investment's required time frame. This means that before you invest, you need a fully funded emergency fund first. 3 to 6 months of living expenses minimum. Your emergency fund is not an investment. It is a financial protection layer, and it belongs in a high-yield savings account. All right, you now understand risk, return, and how to assess any investment product like a professional. Let's keep building. Step 3, and this is where everything comes together, is clarifying your goals and matching them to your investment timelines. Here is what most beginners do wrong: they invest first and set goals later. It should be the complete opposite. Your investments must always serve your life goals. Never separate investing from your life plan. They must talk to each other. A good investment portfolio covers 3 time zones: short-term, medium-term, and long-term. One for each stage of your financial life. Short-term covers 0 to 12 months. Your goals here are things like an emergency, a vacation, or a big upcoming expense. For short-term goals, the priority is liquidity. You need to access that money fast, not investment returns access speed. The best short-term investment vehicle is a high-yield savings account or a money market fund. Easy in, easy out interest while it sits. Medium-term covers 2 to 7 years. Your goals here might be buying a home, funding education, starting a business, or building passive income. For medium-term goals, you want a balance of growth and some stability. You can afford a little more risk here because you have more time. Great medium-term investment options include bond funds, balanced funds under unit trusts, and cooperative societies or credit union savings. A bond fund pools your money with other investors to lend to governments or corporations and pays you regular interest in return. A balanced fund splits your money between bonds and stocks, giving you both stability and growth potential in one single account. The beautiful thing about unit trust funds is that you can start with as little as $5 or 5,000 shillings, no large capital needed. Credit unions and cooperative societies are excellent for medium-term wealth building, especially for home ownership goals. Now for the long term, this is where real wealth is built, and we are talking 10 years or more. Patience is the most powerful investing tool. The primary goal of your long-term portfolio is 3 things: capital appreciation, beating inflation, and building a comfortable retirement. Long-term investment options that have worked proven over decades: pension funds, stock market index funds, real estate, and long-term government bonds. Your pension fund should be your absolute #1 long-term priority. Most people skip this and they retire with nothing. The stock market is the most powerful wealth-building tool ever invented, but it only works when you think in decades, not days. All right, now let me show you what a real simple starter investment portfolio actually looks like. Ready? Here it is. Account 1, a high-yield savings account or money market fund for your short-term needs and emergency fund. Account 2, a bond fund, balanced fund, or credit union account for your medium-term goals like education or home ownership. Account 3, a pension fund or retirement account for your long-term wealth creation and comfortable retirement. 3 accounts. That is your entire starter portfolio. Short-term, medium-term, long-term, every life goal covered. That is it. And here is the most important part: you can open all 3 of these with as little as $5 each. Budget is not an excuse anymore. Now the most critical rule of building your portfolio: you must automate your contributions and leave your investments alone. Compound interest is the 8th wonder of the world. The longer you leave your money invested, the more it multiplies on its own. Someone who invests $20 a week starting at age 25 will retire with more wealth than someone who invests $100 a week starting at 40. Time in the market always beats timing the market. Start now with whatever you have and let time do the heavy lifting. Building a portfolio is a lifestyle, not a one-time event. You must keep topping up your investments as your income grows. A simple habit that changed my investing life. Every time I get a raise or extra income, I increase my investment contribution before I increase my lifestyle. Try this challenge. Pick just one account from the 3 we discussed. Open it this week with whatever amount you can afford right now. Then in month 2, open your second account. Month 3, open your third. By quarter 1, you have a complete starter portfolio. As your knowledge grows, you can add more sophisticated investments, government bonds, individual stocks, real estate, but only after mastering the basics. Before we wrap up, 5 critical mistakes that will destroy your portfolio. Number 1, investing without an emergency fund first. Number 2, chasing high returns without understanding the risk. If it sounds too good to be true, it absolutely is. Number 3, checking your investment value every single day. Long-term investing requires patience, not obsession. Number 4, following investment hype and social media trends without doing your own research. FOMO has destroyed more portfolios than any market crash. Number 5, treating your long-term investments like a savings account and withdrawing whenever you feel like it. Leave them alone. Let us do a quick recap. 3 steps. Step 1, build a working budget that includes your investment as a non-negotiable line item. Step 2, understand risk and return. Build your emergency fund and ask the 3 critical questions before investing in anything. Step 3, clarify your goals. Match them to the right timeline and open 3 accounts: short, medium, and long term. Done. All 3 steps on one whiteboard. This is your complete roadmap for building an investment portfolio from scratch on any budget. Now here is your action item for this week. Grab the free budget template in the description. Fill it in today, not tomorrow. Today. And for those of you who are ready to go deeper, I have a complete investment masterclass linked below. It covers every asset class in detail. Inside the masterclass, you also get my personal company and fund recommendations, vetted, research-backed picks to get you started confidently. Remember, investing in your financial education will always give you the highest return of any investment you will ever make, bar none. If this video gave you at least one new idea or piece of clarity, drop a comment below and tell me what your biggest takeaway was. Also, share this video with one person in your life who needs to hear this message. You might literally change their financial future. Here is one final truth I want to leave you with. Wealth is not built by the amount you earn. It is built by the habits you keep. You do not need to be rich to start investing. You need to start investing to become rich. That is the only order that works. Every financial expert, every millionaire, every wealthy person you admire, they all started exactly where you are right now, with a first step. That first step for you is opening one investment account, any of the 3 we discussed today. One account. This week. Go. If you are not subscribed to this channel yet, hit that subscribe button right now. Next week we are going deep on money market funds, how to pick the best one, what fees to watch out for, and which ones actually grow your money fastest. You do not want to miss that one. It could save you thousands in hidden fees alone. Make sure you are subscribed and that bell is turned on. Thank you so much for watching all the way to the end. That tells me you are serious about your money, and serious people get serious results. Remember, your money will do exactly what you tell it to do. So give it clear instructions, invest consistently, and trust the process. Until next Tuesday, keep budgeting, keep learning, keep investing. I'll see you in the next one. Take care.